Bismillahirrahmanirrahim. Let's start with the today's session. And today in the session, what we are going to do that is to practice different questions from different standards. And let's start with the first question of today's session that is related to the IAS 40. And let's read out the question first. Try to digest the data, what the data is given in this question, and then we will try to solve this question. Okay, let's start with this one. First of all, on 30th September 20x3, company moved out one of its properties and put it for sale. The property met the criteria as held for sale on 30th of September 20x3, which means basically there are two standards which are involved in this particular question. Number one is the IAS 16. Basically, number one is basically the IAS 16. Number one, the IAS 16, and then IFRS and IFRS 15. IFRS 5, sorry, IFRS 5. Two standards are involved in this particular one. So, moved out one of its properties and put it for sale. Remember, whenever we have properties for sale, which means that is the non-current asset held for sale. And if we are having a non-current asset held for sale, so the relevant accounting standard which is applicable is IFRS 5. So we will have a little bit discussion regarding the IFRS 5, that what actually the IFRS 5 is and what is the requirement of IFRS 5. So there is a requirement of IFRS 5. Okay. Moved off one of its property, put it for sale. The property met the criteria as held for sale on 30th of September 20x3. Okay. On 1st of October 2001, that is at the start of the year, the property had a carrying amount of $2.6 million and the remaining life is 20 years, which means at the start of the year, the carrying amount was 2.6 million and the life was 20 years. The property is held under the revaluation model, which means company is using the revaluation model for the property, plant and equipment. The property was expected to sell for a gross amount of 2.5 million with the estimated selling cost of $50,000. What is the total amount? The point to be noted, that is what is the total amount charged to the profit and loss in respect of the property for the year ended 30th September 2003. First of all, let's quickly recall the rules of IFRS 5. That what IFRS 5 states, that IFRS 5 states that if the certain criterias are met, there are certain criterias which I've already mentioned in the book. Soon, hopefully, inshallah, next sessions we're going to discuss this one as well. So there are certain criterias. If the certain criterias, the criterias are like, the if you think that the sale will be probable and the asset will be sold within the 12 months, so there are certain criterias. If such criterias are met, then you should recognize that property, plant and equipment as non-current asset held for sale. Non-current asset held for sale. Now what would be the difference between these two and what would be the treatment for that one? That if the asset is classified as non-current asset has held for sale, which means it will be recorded in the current asset. This asset is going to be recorded in the current asset, and the name of that current asset would be non-current asset held for sale. Like other assets we do have, like cash, bank, account receivable, inventory, we have another asset, and that is known as what? Non-current asset held for sale. Now this non-current asset held for sale should be recognized at its fair value less cost to sell. I repeat, that non-current asset, remember, there are different rules for the different assets. For example, if you talk about the inventory, for inventory there is IAS2.
Lower cost.
IAS, yes, IAS2 states that inventory shall be recorded at the lower of cost or NRV.
One second.
Whichever is lower, inventory will be recorded at that amount. But here the non-current asset held for sale should be recorded at its fair value less cost to sell. That is the straightforward rule which is given in IFRS 5. So now we're moving on towards the question, that the question was that at the start of the year the carrying amount was 2.6 million, and at the end of the year, which means we are going to calculate the depreciation for 2003, the depreciation would be 2.6 million, that is 26 lakh divided by 20. So the annual depreciation would be 26 lakh divided by 20 divided
130.
130,000. So 130,000 is basically the depreciation expense. depreciation expense. And once we recognize the depreciation expense at the end of the year, that is 30th of September 2003, the market value or the fair value is given as 25 lakh. Don't forget that company is using the revaluation model. And if the company is using the revaluation model, before classifying it as a held for sale, we need to recognize the revaluation model. We need to treat it as per the IAS 16 revaluation model. Means that we are going to evaluate the market value, that is 26 lakh, and then we will calculate the book value. Like book value would be to 26 lakh, sorry, so market value is 25 lakh. Market value is 25 lakh. Market value is 25 lakh. Market value is 25 lakh, and the book value would be 26 lakh minus 1 lakh 30,000. 1 lakh 30,000. So 26 lakh minus 1 lakh 30,000. This will make 24 lakh 70,000, which means now the value of 24 lakh 70,000 is 25 lakh at the end of the year, which means is a difference of 30,000. There is a difference of 30,000.
30,000.
And what is that 30,000? That what is that
Impairment.
30,000? No, this is the revaluation surplus as per IS 16. Because what we have to do, that before IFRS 5 states that before you classify a non-current asset held for sale, what you have to do, you need to revalue the asset. You need to revalue the, don't forget, we are using the revaluation model. You need to revalue your asset. First you revalue the asset, and any gain or loss will be arising from that revaluation will be recognized in the revaluation surplus. That means it will be transferred to OCI.
Okay.
Are you getting my point?
Yes.
This is not an impairment, because before moving on towards the IFRS 5, right now we are in IAS 16 ambit. We are right now in the IAS 16 circle. Now it's being revalued. It means all the criterias, rules and regulations as per IAS 16 has been completed. Now let's move on towards the IFRS 5. Now IFRS 5 states that you need to recognize the asset at its fair value less cost to sell. You need to recognize the asset at its fair value less cost to sell. Let me know whether what will be the value of property, plant and equipment at the time of reclassification.
2500
Yes,
less 5.
yes, 25 lakh. That means the value of the property, plant and equipment was 25 lakh, because we measured that property, plant and equipment lastly at the amount of 25 lakh. Now fair value less cost to sell. Fair value less cost to sell. Fair value less cost to sell means 25 lakh minus cost to sell was,
50,000.
which means the fair value less cost to sell would be
2450 000.
2450. Now the value has fallen down from 25 lakh to 24 lakh 50,000. It means there is a downward of 50,000, and that is known as what? The
Impairment.
impairment loss. That is known as what? The impairment loss. Now let's read out the question properly. Here it was written that what is the total amount that should be recorded in P&L. Now can you please let me know the answer for this one?
180.
Yes, how did you came to know about this one?
130%.
Yes, 130 is the depreciation and 50 is the impairment loss. So the total amount that would be charged or recognized in P&L would be 1 lakh 80,000. Are you getting my point now?
Yes.
So by this, we have recalled IFRS 5 as well. That IFRS 5 states that before you reclassify to the non-current asset held for sale, first revalue the asset as per the IAS 16, and then compare that book value with the fair value less cost to sell. One more thing that you need to remember, that once you have classified the non-current asset held for sale, it will be measured at the fair value less cost to sell, and no depreciation will be calculated. Please do remember.
Okay.
Now further, no depreciation will be calculated. Now the question arises that, for example, if within a 1 year, because there are certain criterias that are given in the IFRS 5, that if you are not able to sell that asset within 1 year, once you are
Okay.
recognizing as a non-current asset held for sale, you should state that the sale is probable. That the sale is probable. which means that you will sell the asset within 12 months. Within,
12 months.
yes, you need to sell the asset within 12 months. But for instance, God forbid, we were not able to sell that asset within 12 months. So whether we will start to calculate the depreciation? No, IFRS 5 states that reevaluate your reevaluate, reassess your intention. Whether still you are whether still you are holding that asset for the purpose of sale. Yes. So
Yes.
let's continue to recognize it as a current asset, and there is no need to recognize the depreciation. But
Okay.
after a year, if you says that no, we are not selling that asset furthermore, we'll be recognizing that asset and we'll be using that asset. We have postponed our intention to sell it. Now IFRS states that you just shift that asset towards the property, plant and equipment, and then start your depreciation.
Okay.
Is it clear to you now?
Yes.
So by this we had a good discussion regarding the IFRS 5.
Yes.
Okay, now there is a question that is related to, again, these are the questions from the examiner reports in which the examiner highlights or identifies that these are the most difficult and the challenging questions. And this question is related to IAS to inventory. Can you please try this question?
Yes. See?
See, let's see, let's see. For example, let's read out the question. At 31st March 2003, company had equipment and in its inventories, which was manufactured to a specific customer's requirement and had an original cost of 3,80,000. Okay, it means the cost of the inventory is already given over here. That is 3,80,000. Now the selling price has been agreed as 4,20,000. It means if we are going to calculate the NRV, so the estimated selling price we do have is basically the 4,20,000. Okay, now but new regulations mean that safety measures must be added and a cost of $60,000 before the equipment may be sold. It means before selling the asset or while selling the asset you need to incur a cost of $60,000. Can you please let me know what this $60,000 is representing?
We need to additional cost to complete the product.
Yes, it's an estimated selling expense. It's an estimated.
Selling expense.
Yes, it's an estimated selling expense that we need to incur before we sell this product. Okay. The customer has agreed to pay half of these modification costs through an increase in the overall selling price. What does it means? That out of 60,000, out of 60,000, out of $60,000, half means $30,000 will be borne by the customer. And how is going to bear this one? By increasing the selling price. By,
Increasing the selling price.
yes, by increasing the selling price, by increasing the selling price, which means the estimated selling price was 420, is it?
Yes. Yes.
And
Yes.
we are going to increase it by 30,000.
Yes.
So the estimated selling price will be 4,50,000. Am I right?
Yes.
Okay, now, which means the 30,000 was borne by the customer. 30,000 was borne by the customer. And what about the other 30,000? Will it be also borne by the customer?
No.
No, it's a selling expense for the company.
Yes.
So if it is the selling expense of the company, which means we are going to deduct the estimated selling expenses. Am I right?
Oh, 1 minute. So selling
Yes.
expense for customer we add with the selling price, and selling expense for the company we
Money
deduct
will
from the
be,
initial price.
yes, will be deducted from the estimate, because this is my expense. This is the expense of a company. And if this is the expense of a company, this is gonna to reduce my selling price, or this is gonna to reduce my benefit.
Okay.
Are you getting a point?
Yes.
So it means estimated selling expense that would be deducted would be 30,000,
350.
which means NRV would be,
Um,
4,20,000.
oh, where do you remove the 30? Not in the selling, not in the cost price.
Let me recall it again. Let me
Okay.
read out this paragraph. The selling price has been agreed as 4,20,000. This was the selling price. But
Yes.
new regulations means that the safety measures must be added, which means that you have to give a safety measure at a cost of $60,000 before the equipment may be sold. First of all, we identified that 60,000 is basically a selling expense. If,
Yes.
for example, if nothing is written in this question, for example, let's forget about this one. There is nothing in this one. The question is ended over there. So what I have done, what I must have done, what I have done, for example, what I have to do, that is 4,20,000 minus estimated selling expense of 60,000.
Okay.
This should have been done. When if that statement is not given in the question, if that all particular data is not given in the question, what I have done, what I would have done, that 4,20,000 is the estimated selling price less estimated selling expense, and thereby we have calculated the NRV. Are you getting my point?
Yes.
But now, what is written over here? What is written over here? Here, the examiner states that the customer has agreed to pay for the half of these modification. It means total cost was the 60,000.
Yes.
Total selling expense was 60,000, but alhamdulillah, what the customer said, that I'm going to bear that 30,000. And how is going to bear? He says that customer says that you just increase the selling price by this one, which means now 420 plus 30,000, which means now the agreed selling price or the estimated selling price would be 4,50,000.
Yes.
Is it clear to you now?
Yes.
Now remaining 30,000, who is going to bear that 30,000?
Be the company.
The company. If the company will be paying or bear that particular expense, it means that is the selling expense for the company. Am I right?
Yes.
And how do we calculate the NRV? The formula to calculate the NRV is estimated selling price less estimated selling expenses.
Okay.
This is basically the formula to calculate the NRV. That is estimated selling price less estimated selling expenses. So the estimated selling price was 4,50,000, and definitely this is the cost which is going to be paid by the company. So the estimated selling expense is 30,000, and then
Yes.
NRV would be 4,20,000. Is it clear to you now?
Yes.
Now NRV is 4,20,000, and the cost which was already given in the question was 3 lakh.
380.
Now let's read out the requirement of this question. In accordance with the IAS 2, what is the value of inventories to be presented in the statement of financial position? Yeah, now you just let me know at what amount the inventory
8.
should be recorded.
Lower of course and an.
Yes. Are you getting my point?
Yes.
Don't be demotivated because examiner states that this was the challenging question.
Yes.
And you just you must have observed this one, that these questions are not that difficult but a tricky one.
Even the other one that we did, in fact, I did the fair value less cost of sales, but I did additional in the calculation.
Okay, so this is not that difficult, but you have to be very focused. You have to be very alert and attentive for, just in order to answer these questions.
Yes.
Okay, there is a question now. This time the question is related to the IAS 41. Have you studied that standard previously?
IS 41.
41.
Yes, I did go through it.
It's an agriculture.
Yes.
Okay, basically the name of this standard is agriculture, but at times it is also known as biological asset.
Okay.
It's known as what the biological asset. Okay. In this particular standard, agriculture, this is standard IAS 41. IAS 41 deals with two things. Number one, the biological asset, and the second one is the agriculture produce. Let me give you an overview for this standard so that we can cover this one as well. What is asset and the agriculture produce? For example, if we talk about biological asset means plant and animal, plant and
Animal.
animal, a living plant and animal. Let me correct it. Living plant and animal. Number two, that has some biological transformation. That has some biological transformation, which means that it grows. Let me give you an example. For example, this is the pen. I'm selling that pen. I hold that pen in order to sell. I'm having that pen and I'll be selling that pen. What is this for me?
Pen.
It's pen, but how would you classify it? Is it the liability asset or what?
Asset.
And which asset it would be classified as?
Current asset.
And in current asset, what would you name this one? It's held for sale.
Inventory.
Yes, it's an inventory. Now let me change the example. I do have an animal. I do have a cow. I do have a cow or a goat. And what I sell this cow. I usually trade in that particular cow. I usually trade in that particular goat. It means that I am here to deal or to trade with that particular cow. I buy I buy the cows and then I sell it to the customers. Now
Yes.
this cow will not be classified as inventory as per IAS2. Instead, it would be classified as IAS 41 under the head of agriculture.
Okay.
Now, why? This was the pen, and I hold that pen for the purpose of resale. Now I am having a cow, and again, I hold that cow for the purpose of resale. Both the products were held for the purpose of resale. The difference is the cow is a biological asset because it contains a feature that it is a living plant and animal, and it has biological transformation. What is transformation? Biological transformation means that it increases. For example, I bought a calf, that is the son or
Yes.
daughter of a cow, and then it just started to grow, which means it's increasing day by day. It's
Yes.
increasing the value, the weight, and the structure. It's increasing day by day. That is known as what the biological transformation. And if you
Okay.
talk about the pen, whether it has some biological transformation,
No, it remains the same.
no, there is no. It means if after 5 years the size and the weight of this pan would remain the same, which means this will be classified as an inventory, and the plant and animal is having a biological transformation. For example, I bought a small plant and then I just bought it, and by the passage of time it will grew, and the time will come, it will become a very strong tree. Am I right?
Yes.
So
Yes.
this is known as what the biological asset. So in this particular accounting standard, we are going to take the treatment regarding how these living plants and animals should be recognized.
Okay.
Now, what is agriculture produce? For example, I had a tree. I had a
Yes. Quick.
I hope this seems like a tree.
Yes. Your
It
drawing
seems.
is good.
Thank you. I take it as a complimentary, and let me have some more creativity on this one. Uh, let's okay.
Some mangoes.
Mangoes, it would be difficult for me to draw. Okay, let's make some apples with the red color. Okay, so there is, I'm sorry for this one. This is an apple.
Okay.
Assume that these are the apples, okay?
Okay.
So now, these are the apples. These are the apples which are on tree. Okay, now the output of the biological acid. Remember that tree is a biological acid. That tree is a biological asset. It's a living plant. And the fruits which are lying on that tree, and the fruits which are lying on that tree is known as what? Agriculture produce. It is known as what?
Agriculture produce.
Yes, agriculture produce. Now listen to me very carefully. These are considered to be the agriculture produce until and unless these are attached and connected with the biological asset.
Okay.
Once this agriculture produce is picked, do you understand the word picked? That if I just picked it,
Yes.
if it is dropped down, if it is picked, let's see the apple which is lying on the floor, apple which is lying on the floor, there's another apple, for example, there's another apple, it fell down, and here it is. So apple which is dropped down or it is picked, it's no more the agriculture produce, it's no more the agriculture produce, and now this will be recognized as an inventory. Are you getting the point?
Wait. The tree is the biological asset.
The
Okay.
tree is the biological asset, and the
Okay.
fruits which are lying with the or connected with the biological asset is known as what? The agriculture produce. And once the fruit or the agriculture produce is dropped down or is picked or is separated or is
Oh, yes.
harvested from
Yes.
the biological asset, it's no more the agriculture produce, but now it will be considered as an inventory.
Okay.
So it means on that tree IAS 41 will be applied. On that apples which are attached or connected with the tree is also classified as an IAS 41. Are you getting my point?
Yes.
And the apples which are laid down or which have been picked will be classified as IAS 2.
Yes.
Are you getting my point?
Yes.
Okay. Let me give you another example for this one. I hope you will not afraid of this one. Let me try something. Bismillah. I don't know what's coming to your mind, which animal or
Should be a cow, right?
thank you so much. Otherwise, when I usually draw this diagram in my physical classes, somebody says that it's a donkey, some says that it's a dog, some say it's a pig. Like different comments I just received from this one. First time I heard that somebody says that it's a cow. Okay, yes, it's a cow, and it's a cow, and that cow is a biological asset. That cow is a
Biological asset.
yeah, it's a biological asset. And let's say there is a basically the milk is of white color, but if I will draw a white color you will not be able to see the milk. Let me see. So here's the milk, here is the
Okay.
milk, here is
Yes.
the milk.
Milk
That milk inside the cow is
is
known as what?
agriculture.
Yes. And once it is harvested, and once it is
It
harvested,
will be inventory.
yes, and once it is harvested, this will be known as what? Inventory, and be dealt according to IST. Are you clear with this one?
Yes.
So now IAS 2, IAS 41 agriculture. IAS 41 agriculture states that agriculture produce, that is agriculture produce or the biological asset, should be recognized at its fair value less cost to sell. Which means the biological asset should be recognized at its fair value less cost to sell. Biological asset or agriculture produce should be recognized at its fair value less cost to sell. Are you getting my point?
Mm-hmm.
Fair value less cost to sell. And it should be measured at the end of the each reporting date. For example, if the fair value less cost to sell was 100 at the start of the year, now at the end of the year the fair value less cost to sell is like now 120. This could happen.
Yes.
It is possible. For example, I bought a cow, it was very small, it was a calf, and once it will be bigger or it will get older, so definitely the value of that cow would increase.
Yes.
Value of that cow would increase. So it means if the value of the cow is now right now 120, so which means there's an increase of 20,000, this will be recognized as a fair value gain, and this will be directly recorded in PNL.
Okay.
Are you getting my point?
Yes.
But if, for
Any
instance,
gain or
yes,
loss, it will be
yes, and if
recognizable.
there is 100 and the fair value less cost to sale is like now 90, now there is a loss, and this will again be recognized as P&L and will be known as what, fair value loss. Are
Okay.
you getting this one? Is it clear to
Yes.
you?
Yep.
Okay, now let's move on towards the question. Company purchase a herd of, one more thing that I would recommend you, that related to that IS 41, I have shared a PDF file, PDF book with you. If you just move on that standard, there are examples of agriculture produce and the biological asset. I would
Mm-hmm.
recommend you to learn those examples, because at times examiner asks a very simple question related to that, which of the following would be classified as an agriculture and which of the following would not be classified as an agriculture.
Okay. Excuse me. I think there's two exceptions, right?
Which one?
Timber. No.
Yes. There are multiple exceptions. Logs could be an exception for this one. Do you understand regarding? Do you know about logs?
No. What's that?
Logs are basically when trees are cut it down. When trees are cut it down into big pillars,
Yes.
like
Yes.
if you would search on Google, you will got to know about this one. It's like a wood.
Okay.
It's like a wood. So
The
these
trunk.
woods, yes, these woods are known as what, logs. Logs, logs.
Okay.
These are also not considered as an agriculture produce. These are not also considered as a biological asset. So there are different examples. There are
Okay.
different examples. And once you will go through that example, you will get to know that these are classified. And the examples which are given in the book, which I have provided you, are the examples taken from the standard directly. These
Okay.
examples are taken from IAS 41, that is from IFRS. I have extracted these examples directly from the standards. So you just go through those examples and try to memorize it. We are not here to do the agriculture farming, or we are not going to specialize in this one, and there's no need to get to know that what does it means and what does it means. You just need to memorize it, because we are not going to have a specialization in that particular farming activities.
Okay.
Are you getting this point?
Yeah.
There could be multiple examples for this one. For example, a chicken or hen. I don't want to make
Yes.
a chicken or hen over here. It would be a pathetic diagram for this one. But if there's a chicken or hen, and the eggs inside the hen would be considered as an agriculture produce, and when it
Yes.
lays down the eggs, it would be considered as inventory.
Okay.
Now, okay, let's move on towards the question side now. Company purchase a herd of 600 bison. Bison is basically animal.
Okay.
It's like a goat. If you search it, you will get to know it's an animal. On 1st February 2005, and correctly recognize the transaction at $90,000, which means they have recognized that agriculture or that biological asset at a value of $90,000, which means they have recognized the biological asset at the value of $90,000. This must be a fair value less cost to sale. Okay. At 30th June year end, the market price of the similar size of the herd was $175 per bison, which means that the 600 bisons are there, and the market price at the end of the year is 175 dollars per bison. All tradings of bison occurs 8% 8 incurs 8% of cost plus an additional fixed charge of 1 per bison. Can you please let me know that what does it represents?
Selling expense.
Yes, it's a cost to sell. Don't use the word selling expense. In this standard example, no doubt it's a selling expense, but here the terminology cost to sell is used.
Okay.
Now, it means the biological asset was valued at 90,000. Now, what we have to do, we need to calculate the fair value less cost to sell. Am I right?
Yes.
Now, fair value. How are we going to calculate the fair value? The fair value is 175,
175 times 600.
600. What is the amount of fair value?
105 triple zero.
105,000, and
Mm-hmm.
there is a less selling cost, or the cost to sell is 8%. Can you please calculate the 8% of 105,000?
8400.
8400. And further, there is another cost to sell, that is $1 per bison. $1 per bison means 1 multiplied by 600.
600.
So can you please calculate the fair value less cost to sell?
96,000.
96,000, 96,000, which means the value of biological asset at the start of the year was 90,000, and now the fair value less cost to sell is 96,000. So we are going to recognize that biological asset at a value of 96,000. Are you getting my point?
Yes.
And if I just ask you, no doubt the answer is B. Answer is B. If I just ask you that what will be the gain or loss?
So it will be 105,000 less
Hmm.
than no.
It's simple as straightforward over here. Na? That is the 90,000 and the fair value less cost to sell is
Oh,
96,000.
we don't
So
take
that,
the fair value. We take the fair value less
yes.
cost to sell.
No, 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 no. Whenever we are going to calculate the gain or loss, the formula is the fair value, that is the value, and we will take the fair value less cost to sell.
Okay.
Are you getting a point?
Yes.
So there will be a fair value gain of $6,000. Are you getting my point?
Okay.
And this will be recognized in?
Profit and loss.
Yes. Is it clear to you now?
Yes.
So I hope this standard is now in a better position.
Yes.
Were you aware of all of these things
Not
previously?
really. No.
Great. Let's move on.
Which one?
This question is related to IAS 40.
Okay.
Sorry, it's not from IAS 40. It's IFRS 9.
Instrument.
Yes.
Invested. Invested. So it is an asset.
Nice. Very good. A very good
Equity
strategy.
share. It will be investment in asset. No, no. Financial asset. I mean, right?
Very
Equity
good.
share. Yes. The shareholding was fair value for other comprehensive income. So, okay. Invested equity share financial assets. Through fair value OCI. Okay. Million. So 20 million and 0.8 million as broker fee. Broker fee will be the transaction cost.
Very good.
Transaction cost. Okay.
Assalamualaikum friends, this is Junaid Khalid, your host.
So the first entry will be um, debit
Mm,
investment credit bank. So, The shareholding was less than 1%. Um, Here the transaction costs need to be capitalized. 8 million debit credit investment. 8 million bank.
By the way, which method it is using right now? Fair value?
OCI.
Yes, fair value through OCI. So always remember, if there is any fair value gain or loss, this will be directly recognized too.
OCI.
Yes, it will not be recognized in P&L. Okay.
Yes. Okay, and this one except if I got this will what if the shareholding was less than 1%?
Uh, it's nothing to do with that one.
Okay, so
There is no use of it.
okay. Fair value of investment particular with debit investment for homes. Consume
Have you
and
calculated the fair value
credit.
gain?
Yes,
Can you please guide me
four
with this one?
hundred thousand.
Like what we have done. First of all, you identified that it's a financial asset.
Yes,
It's an investment, right? And
yes,
secondly, it's an investment in equity,
yes.
and we are using the fair value through OCI. Is it?
OCI. Yes,
Okay. So in that particular case, any transaction cost will be capitalized.
yes.
So it was 7.2 million is the investment and 0.8 million is
Eight,
the transaction cost. So the
8 million.
investment value would be $8 million. So far you reached there.
Yes,
Okay, now on 31st of December 2000, the fair value of the investment was 8.4 million, which means
yes.
the fair value is 8.4 million. That is the difference of what?
400.
400. And this is the fair value gain. Am I right?
Yes,
And this will be recognized in OCI.
OCI.
Now, this has been done. Now, after, and this was correctly accounted for. Okay. On 31st March 2008, it means after few months, that is after 3 months, on
Mhm.
31st March 2008, company sold the entire investment for the cash consideration of 8.9 million. Now, can you please let me know that what was the value of investment for the
In
disposal?
8 4.
8.4 million. Is it?
Yes,
And now this was sales and the sold for sales proceed. What is the sales proceed for which amount it was sold for?
8.9.
8.9. So can you please continue with this one?
0.5.
0.5. The investment which had a value of 8.4 million was disposed of for 8.5, 8.9 million. Whether it's a gain or loss,
It's a gain.
it's a gain. It's a gain on disposal. So any gain on disposal arising from the investment will be recognized. Where it will be recognized?
In OCI.
No. Any gain or loss on disposal, any gain or loss on
Of
disposal, not
profit
fair
and
value
loss.
gain. Yes, this will be recognized in profit and loss, irrespective whether you are using the fair value through OCI, or if even if you are using the fair value through PNL. In both the cases, any gain or loss on disposal will be recognized in PNL. Are you getting my
Okay.
point?
Yes.
Is it clear to you? So let's read
Yes.
the requirement. What gain or loss of on the investment to be recognized in P&L? Remember, here the examiner is asking for the P&L, profit and loss, which means if the examiner is asking for the profit and loss, so we are not going to mention that OCI gain.
Okay.
Are you getting a point?
Yes.
So
Only
the
the
answer,
revaluation which goes to the OCI.
yes, yes. The gain, that fair value gain will be recognized in the revaluation, that is in the OCI or the equity section.
Okay.
Is it clear to you?
Yes.
Okay, this is the question that is related to ratios.
Okay. Implementing profit margin decrease from as also to 11 also. Operating profits, a profit before interest and tax over sales or revenue times 100 or operating profit. To providers of finance increase the rate of interest. If rate of interest increase before interest won't be affected. Following a review of non-Canada trade discounts for both kinds. Yes.
Yes,
C and D.
we
C
we
and
need
D.
C and D. Okay, why C?
C.
Can you please
So
first
operating
can you please first explain me the situation that what's going on here?
operating profit has been decreased from 15 to 11%.
Okay, it means operating profit margin or the net profit margin has been decreased by 4%. Okay, I
Yes.
continue.
So for
Okay,
this,
can you
it
please
will
give me
be
the can you please let me know the formula for the operating profit margin?
operating profit or profit before interest and tax over sales or revenue times 100%.
Nice, nice, very good, very good. Are you practicing for this chapter as well?
I just did it before you called me.
Great. Clever. Okay. Now, which means that operating profit margin has been decreased by 4%. It's been decreasing by 4%. Okay.
Person.
Now, which means that the profit, and always remember that I told you that if the ratio is decreasing, it means the numerator,
Is decreasing,
yes, numerator is decreasing.
decreasing, or the
So
denominator is increasing.
increasing. Okay. Now, read out the third one. Company
Yes.
successfully negotiated the trade discount for the bulk buying raw
Right.
material from its existing suppliers. If I'm getting the discounts, it
Yes.
means my purchase price would,
It will still be increased because you're making a purchase.
if I'm getting the bulk discounts, if I'm getting the discounts, my amount of purchases would increase or the decrease.
Instead of increasing by 100, it will increase by 80. You got 20
Yes,
discount.
yes, it means there will be a decrease. For example, if I'm having a purchase of 100 and subsequently supplier offered me a discount of 20, now my purchases, amount of the purchases has increased or the decreased?
Decrease.
Yes, which means that discounts will reduce your purchases. And if I would say purchases is an expense nature, and if the expense is reduced, and the expense is reduced, it means the profit will increase. Am I right?
Increase. Yes.
And if the profit is increased, which means the numerator is increasing. So
Yes.
because of this reason, operating profit margin will not reduce. Instead, it should have been increased.
Yes.
Are you getting a point?
Yes.
So this should not be the answer for this one. Can you
D.
find out
D.
D? Nice. It's perfectly fine. But we need another one.
Okay. Co-providers of finance.
Can you understand with the D one? It's it's clear. It's crystal clear, I
Yes,
guess.
it's expense.
Yes, because the expenses are increased, so definitely the profit will reduce and the net profit margin will also decrease.
Yes. Rate. Increase the rate of interest on loans payable, but the profit that we are taking for the calculation of operating profit, it's before interest.
Yes, very good.
It's
Excellent.
not
Very
a.
nice. Very nice. Very impressive. Because the profit which we are considering is the profit before interest and tax. There is no impact of interest. So it means you have
So it's
eliminated
B.
the A1 as well.
B.
It's B. Yes. Why? Because of following a review of the non-current asset, revise the useful lives of the or useful lives of the plant and equipment downward. Now, what does it mean? For example, I was having an asset of $100 and the useful life was 6 years.
Okay.
Can you
Oh,
please
okay.
calculate the depreciation for this one?
100 divided by 6. 60, 17.
17. And I just decreased the useful life to 4 years now,
25.
which means the depreciation expense
It's been
is,
increased.
and if the depreciation expense is increased, it
Profit
means
will
the profit
reduce.
will decrease and ultimately the operating profit margin will also reduce.
Yes.
Did you got the point?
Yep.
Did you got the strategy that how to cope up with this one?
Yes.
So the correct answer is B and D. Okay, now it's IFRS 15 question.
Mm.
There is a scenarios given over here. We can read the scenario and how we going to read it. First of all, we'll see the requirement, and if in that requirement, whichever the contract it will be targeting, so we will read that particular data. Okay.
Okay.
Now let's have a question. First question, that is the various methods had been proposed by company for measuring the progress of the contract with Loho company. Now Loho company, let's see. Can you find out Loho?
Yes, the first one.
The first one, is it? Okay, now let's read this data for this one. A large item of plant is being constructed for Loho company. The plant is controlled by Loho company and is being constructed directly on its premises. It means what we are doing, we are constructing a plant for our customers. The
Yes.
contract price is 1.8 million. Are you familiar with
Mhm.
this one?
Yes.
At 31st August, progress was assessed at 50%. It
Okay.
means they have assessed that 50% task is completed and the
Yes.
company invoiced with the amount of 1.0 million, that is 1 million, and the invoice was
Yes.
settled on 31st August. Company incurred recoverable contract cost, the cost incurred to date. Am I right?
Recoverable contract cost is incurred to date.
Yes, cost incurred to date so far is 0.7 million to 31st August, and total expected contract costs are 1.3 million. It means the total expected cost, total estimated cost is 1.3 million. Are we clear on this one?
Yes.
Now let's read the requirement again. Various methods have been proposed by the company for measuring the progress. It means they have suggested different methods to measure the progress.
2 and 3.
Excellent. Mashallah, you're getting
Yes.
lion.
And for Luhoko, since it is given 50%, it is output.
Yes, very good. Very good.
Okay.
Excellent. Are you getting one? Are you getting this one?
Yes.
Good one. So you are become a tiger, mashallah. Okay. Now, let's read out another question. In accordance with the IFRS 15, which of the following above methods should be appropriate method for measuring the progress of the contract with logo company? I guess there is, okay, 2 and 3. Oh, so this was the answer for 2 and 3. This one, right?
Yes.
Option A was the correct answer for this one. Okay, now let's move on to another question. In accordance with IFRS 15, calculate the contract asset or liability to be presented at 31st August. Do you remember the formula for contract asset or liability?
Yes.
Can you please recall that one?
Contract asset or contract liability. We need to do the recognize
R-
revenue, the
Revenue
percentage.
recognized, yes,
Yes.
revenue recognized to date, and then we deduct what?
The cost to date.
Amount invoiced.
Oh, you're doing directly the balance sheet. You won't
Yes,
pass
because
through the
because
profit
no
and
no
loss.
there's no need to do that because here it is asking for the contract asset.
Yes, yes, yes.
Revenue recognized today and the amount invoiced will be deducted. Now
Okay.
let's first of all identify which contract it is talking about. That is
The
again the
con
Loho company. Okay, Loho company. And here the few data is also given over here that its revenue for the year ended 31st August was analyzed as follows. That from Loho contract they have recognized a revenue of 900. Now let's read out this one first. Let's read out this one. The total contract price was
total contract price eight one
1.
point eight million.
And if you just move on towards the step one, let's say if you are desired to perform the step one, that was to calculate the profitability. So the contract price was 1.8 million, that is
8
18 lakh,
and
and the
total
total
cost
estimated cost is total cost
2
is
million.
two. It's
1.3 plus
1.3 million.
0.7.
1.3. Yes. No. It's 1.3 is the total expected cost. Total contract cost.
Oh, okay.
It's a total expected cost. Are you getting
Okay.
my point?
Yes.
Yes. Total cost is
1.3.
1.3 million, that is 13 lakh, which means it's a profitable contract. Am I right?
Yes.
Now, step number two, we need to identify the percentage of
Percentage of
completion,
completion. It is
and it's
50%.
50%. Now, step number three, let's prepare the P&L for this one. And
Yes.
if you're going to prepare the P&L, so the contract revenue that should be recognized, revenue to be recognized is 18 lakh
50%.
times 50%. This would be
Wait. So, 90. 900.
900. 900, is it? Which
Yes.
means they have already recognized the revenue and that is the correct amount. Am I right?
Yes.
Okay. And what will be the cost?
The cost is cost to no, for which one you are looking for? Cost for the statement of profit cost to date.
Yes, cost to date. And what is the cost to date?
0.7.
Yes, 0.7, that is 7 lakh. Cost to date. So the profit recognized would be
200.
200. Although this was not required, but we just did it so that you can recall it. Now, what is the requirement of a question? What is the requirement of a question that we need to calculate the contract asset? And how are we going to calculate it? First of all, we need the revenue recognized. And what is the amount of the revenue recognized? What is the amount of revenue recognized?
900.
900,000. 900,000 is the revenue recognized. Okay, let's move on towards the format which we have made. That is revenue recognized is 900,000. And
Less amount invoiced.
is there any amount invoiced to customers?
Yes, yes, yes.
It's
1 million.
nice. That is 10 lakh. Now, can you please identify that what would be the answer for this one?
It's a liability.
Very good. With the amount of?
100.
Very good. It's a contract liability. So the option would be,
The option will be B.
yes. Are you clear this one?
Yes.
Okay. Let's move on to the other question. Other question. That
Hope
was the,
this. Hope I get one OT case on this.
sorry?
Hope to get one OT case on this one.
Hopefully, inshallah.
One on this, one on impairment, and one on.
IFRS 9.
Okay, can manage.
Okay, great. Let's move on the another question. Let's move on the another question.
It's the amount of income recognized by pension.
Now it means we are going to move on towards the contract. The name is pension. Now, first
The
of all, we need.
question itself is the company is pension in relation to
Oh, sorry, sorry,
Dapping,
sorry, sorry,
Dapping,
sorry, sorry, sorry. In relation to,
Dapping.
yes, damping company. In relation to damping company, damping. Yes, here we go. That is the second one. Now let's read out. Equipment was sold to damping company on 1st March 2004, allowing damping company credit terms of 1 year. It means we have sold it, and for a credit term of 1 year, interest free. Nice, very good. This is significant benefit for damping company, no doubt. And the pension company cost of capital is 7%. It means they have sold the goods on a credit period of 1 year. And I told you earlier that whenever we are going to sell any asset or anything or any product, and the time period is material, and the time period is
Material.
material. So we are going to record that amount. We are going to record that amount at a value of, we are going to record that amount at what amount? At what value we should
3
record it?
million.
Sorry?
Present value.
Yes, it should be recognized at its present value, which means we have sold that product or the asset for a credit period of 1 year, and whenever the cost of capital is given, it means examiner requires you to calculate the present value. Are you getting a point?
Yes.
Okay. Pinkan Company recognized the full and final amount of 3.0 million to be paid on 1st March within the revenue. Is this the revenue correctly recognized?
No, we need to do the present value.
Yes, we need to first of all calculate the present value. Can you please calculate the present value of it? That is, it is 3 million divided by 1.07 power 1. Am I right?
Yes. One sec. No.
Yes.
And this one. 2803.
That is
Two
2.83
eight
million.
zero 738.
That is 2 decimal
2.8.
2.83. Is it?
Yes.
That is the present value. It means the revenue should have been recognized at this amount. First thing.
Yes.
That is on 1st March. But remember, 1st March, once we are recognizing the revenue, no doubt the revenue will be recognized at this amount. And once it will be recognized at its present value, at the end of the each reporting date, what we'll be doing?
Depression.
No, 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 no,
No,
no.
interest. Interest.
Yes, that is known as what? Unwinding. That is known as what?
Unwinding.
Unwinding. What we'll be doing? That we will be doing the unwinding. And how we going to do unwind? That is 2.83 in times 7%. Am I right?
Yes.
Anything else?
No. There's a payment, but the payment
1st
is
March
to
we
be
had an
paid on
agreement.
first March.
1st March we had an agreement,
Oh,
and
we had
31st
to
March.
divide it by 12 and
Nice, very good. And multiply by.
March, April, May, June, July, August, September, October, November, December, 10.
Uh-huh. Where are you going? March, April, May, June, July,
August.
August. Yes. So it would be
March,
six.
April, May.
Are you getting my point?
Yes.
Because what we are going to do, we are going to unwind at the end of the reporting date rather than on the payment date.
Yes.
So what will be the amount of unwinding?
98.
0.09? Is it?
No.
2.837% multiplied by 6 divided by 12.
Therefore, the part outside also divided by 0.09, yes.
Yes, 0.09. So that is the interest income basically. Remember, this will be
Okay.
known as what? Interest
Income,
income. Reason? Because this was the sales. This was the receivable, accounts receivable. Am I right? Whenever we
yes.
are doing the unwinding for the receivable, so that interest will be known as what? Interest income. If we are going to, if we are having a liability, if we are having a,
Liability,
so any unwinding, this will result to interest.
expense.
Yes, remember this one, okay?
Okay.
So this will be treated as an income. So the total income that will be recognized at the end of the year one would be 2.83 plus 0.09. So the total income that would be recognized in P&L,
2.9.
2.9. Are you getting a point?
Yes.
So can we just identify the answer for this one?
B.
Yes. Are you clear on this one? So in this
Yes.
particular question, you have learned that the first of all, the present value, how to calculate the present value. And second most important thing is whenever you recognize any amount at its present value, there is a need for the unwinding. And the third thing that you need to learn, that is to prorate. Are you getting my point?
Yes.
And the
Yes.
fourth
Yes.
thing that you need to remember, that is it was not the interest
Income.
expense. Yes, it's an interest income. So these are the few learning outcome from this particular question.
Yes.
Okay. Now there is another question. That is, I guess, the question number four. It was three. It's four. Okay. There is no significant financing component in the contract of Futin. So it means we are talking about the Futin, I guess.
Yes.
So let's move on towards the Futin. Now, here's the paragraph for this one. An
Mm.
item of plant with a standalone selling price of 4 million. Standalone selling price. Can you recall that one?
Yes.
Was sold to Futin Company on 1st June 2004 specifically for this contract. The transaction price of 4 million includes, it means we are charging to the customer with the 4 million, and the transaction price of 4 million includes 1 year servicing contract. It includes 1 year servicing contract at no extra cost to Futin Company. 4 million was invoiced to Futin Company on the date of delivery, which was 1st of June. So far, the data is clear to you, which means
Yes.
we are providing how many performance obligation are there basically?
2.
Very good. That is number one, the product, and the second one is the service for 1 year. Is it?
Yes.
Okay. Now, the cost of servicing the plant is 0.3 million. I told you earlier, there's nothing is free in this world. Although the examiner or the company is stating that we have no extra cost for this one, we are providing it for the free. We are providing it for the free, but IFRS 15 states that nothing is free in this world, which means there is something that you need to recognize. There's a need to recognize the standalone selling price of this one. So here is the estimation given over here. That is the cost of servicing plant is 0.3 million per year, and company quarterly charges a markup of one third on the servicing of plant, which means that is the cost to the company. And once they sell it isolately, what they do, they charge one third. It means 1 upon 3. This means that 3.3%, sorry, 33, I guess. It means they are charging 33.33% markup on that particular services. So this is basically the cost. And if you are given with the profit percentage, can we calculate the selling price of it?
Yes.
Now, what we have to do, let's see the requirement of it. What is the requirement for this one? What is the contract? What is the correct amount of revenue to be recognized in the statement of profit and loss? We need to calculate the revenue amount. We need to calculate the revenue amount. First of all, let me know that how many performance obligation are there?
2.
Goods and as well as the
Service.
total transaction price is 4 million, no doubt. And for goods, it is it
4
was 4
million.
million. It's 4 million. 4 million. It's there that the standalone selling price of the goods is 4 million. But for services, there is a hint that is given over here, and the hint is that 0.3 million is the cost. Am I right?
Yes.
0.3 million is the cost, and there is a markup of 33.33%. Can you please calculate the selling price of it?
Yes.
Please
Also,
do the needful.
so 0.3 includes the markup. No.
Yes, 0.3 is basically the markup. Yes, have you calculated this one?
33.
33. 0.3 million multiplied by 133.33333, because 0.3 million is basically the cost. We need
We
to
need to
calculate the
add the
selling.
markup.
Yes, we need to add them the markup,
Okay,
which
okay.
means that 100 plus. Are you getting a point?
Yes.
And divide it by 100,
399,000.
399, or if you will just write off that is 0.4 million.
Okay.
Always remember, try to have a calculation in which the answers are given.
Yes.
Otherwise, you will waste your time in calculating the values and by adding the zeros and deducting the zeros.
Okay.
So the service is 0.4 million, which means the total amount of that of both the product is 4.4 million,
4.4 million.
and the transaction price which we are charging right now is
4 million.
4 million. Is there any discount?
Yes.
Discount of,
0.4.
and what we have to do, we need to allocate that discount.
0.4 divided by 4.4 times 0.4. Oh,
Divided by 4.4 multiplied by 4.
yes.
So
So
what's the answer?
0.4 divided by 4.4 times 4. So 0 decimal
36.
36.
0
And the other
decimal
one is
36.
0.4 divided by 4.4 times 0.4. The other one is
0.04.
0.04.
0.04. Is it? So it means the
Yes,
discounted price would be 4 minus 0.36.
4 minus 0.36. 3.64.
3.63. Is it? And what about the discounted price of services?
That is 0.36.
0.36. Is it? So the total transaction price that will be, that is 4
4.
million. Now we have to recognize the revenue. Now let me know whether the revenue of a goods will be recognized point in time or over the time.
So the first one, wait, for which year they are talking?
For the
31 August. It was sold on June. It the first one it will be point in time.
Very good. The first one is the point in time. It means the first revenue will be recognized in the point in time. Nice. It means this will be recognized in point in time. And what about the 0.36? Whether it will
Over
be point in time or over the time?
over time.
Over the time. As is it?
Yes.
Over the time. Over the time. Now, can you please let me know that what amount of revenue to be recognized for the year ended 31st August? Please be careful. We had an agreement on 1st of June. We had an agreement on 1st of June 2004, and our accounting period is ending on 31st of August 2004.
A.
First, let me know that what you did.
I
Uh,
took the whole of plant 3.363 plus
3.63 plus
0 decimal 36 divided by 12 times 3.
divided by 12 and times.
3.
Nice, very good. Excellent. So, what is the total answer?
I got 3 decimal 72.
3.72. Nice, very good. 3.72 is the amount of revenue that should be recognized. That is approximately,
73.
yes, A. Are you clear this one? Are you clear with this one?
Yes.
Question number 5.
Oh, yeah.
It's it's a Yanshin contract, but I think there's no need to read that paragraph. If you wanted to, you can read the question. You can read the data.
Allocate the discount proportionately. Recognize. Not A, not B.
Sorry,
Recognize. Not the first two answers.
not the first two answers. Okay.
Recognize revenue as the
Nice, very
sum.
good. It was a good
Okay.
strategy to eliminate the first one because these are completely irrelevant. There is no as such point to allocate the discount on the highest or lowest values. Very good.
D. The last one.
Last one.
Yes.
Can you please reconsider your statement?
We take the sum of the standalone selling prices with the
Recognize the
discount.
revenue as the sum of standalone selling prices. True. With the discount allowed recognized separately as an expense. Do we record the discount allowed at expenses separately? If we just recognize the revenue for this one, what entry we are going to prepare? That is the account receivable debit and the sales credit with the
Of
amount of
C.
3.63. So is there a
Yes.
need to recognize the discount allowed separately?
No.
No, it means we do not recognize the discount allowed separately. What we do, we basically adjust the discount in the selling price. Adjust the discounts in.
Selling price.
Are you getting a point?
Yes.
So now let's read out the third case. Allocate the discount. Am I right?
Yes.
How to allocate? Proportionately. Is it good
Yes.
to go? To both
Yes.
the items and equipment. So far, what we have done in the same way. What we did, we calculated the discount allowed. Calculated the discount. And what we did, we allocated the discount proportionately in both the items.
Yes.
Are you clear with this one? Is it clear to you now?
Yes.
So far, we had a very good discussion on the IFRS 15 in the today's session, and then some discussion on the ratios, IFRS 9, IAS 41, IAS 2, and IAS 16, as well as IFRS 5. So, are you clear with this session now?
Yes.
Is there any confusion, any problem?
No, it's okay.